Yeah, they're up. There we go. And we're live. Well, little different than the optimism we had last week. We've seen a complete 180 in the bond market. Country Garden, China's biggest developer, defaults, and the world's on fire. But hey, I thought it was appropriate today that we do this. I just thought, maybe we need to change things up a little bit, and I figured, the way
I wore a bow tie at that.
Yeah, I like it. I like it. You look
changing things up a little bit.
The checks, looking good. So I saw that and I kind of laughed. I just had to laugh. It was just kind of fun. So our unemployment numbers are holding steady. So this came out this morning, right?
I'm really impressed with how strong our economy seems to be doing with these numbers.
Yeah. I mean, my gosh, unemployment fell 13,000 units to 198,000.
Under 200,000. This is amazing, right?
Yeah. And what were you telling me? How well the companies with, was it 50 employees and under? Or
so the WARN notice, which is a federal notice, is like they're skyrocketing right now. This is for companies that have 100 plus employees that intend to lay off at least 50 employees, and those numbers are at the highest level that they've been in over a year. But we're not seeing it reflected on these.
Hold on, let me check those.
Like
that's what they got.
I see how strong, and this is confusing because it's like, we talked about this earlier this year when you look back and you see those numbers and they got revised up a lot.
Mm-hmm.
In like August, September, all of a sudden those May, April numbers were revised up. Are we going to see the same thing happen? Maybe not this year, but maybe January, all of a sudden they're going to revise October, November, December numbers up.
Was that kind of like they did in March?
I feel
or like the past 6 months before that.
I think that's kind of what we're going to see happen again.
Yeah. Well, they don't count 1099 people who can't file for unemployment.
That's true.
And there were 60,000 real estate agents who have dropped out.
60,000 real estate. So wait, yeah. Real estate's not been the same market that it was?
No. No, it's been interesting.
It's a little bit different.
A little bit different. So, and I'm sure they've got all the mortgage brokers in this number too, right? And the processors.
Probably do. Well, mortgage brokers, we're all going to have I think you'll see that number because real estate is in October.
Yep.
And then loan origination licensing is renewals at the end of December. So January, that's when we're going to see loan originators change.
Gotcha.
But it's an interesting market. It's not fun for everybody. I don't think it's really fun for anybody right now.
Mm-hmm.
With what's going on with the bond market, right?
Yeah, I mean, let's look at this one kind of hurt today.
Ooh.
We are fast approaching the 5% yield on the 10-year T.
Yeah.
I mean, we're sitting right now at 4.93. And we had, and it was kind of nice because if you go back a little bit, last week we had that little dip.
A little bit.
We caught it. Right
maybe
here.
We'll finally bounce back down, right?
Yeah, we're like, maybe we're steady. Maybe we're steady because you kind of looked at the 50-day average and it's like the 50-day average was down here, and it just broke another ceiling, and it's just not stopping. So it's the Treasury is doing what the Fed wanted to do. So Yellen is actually kind of doing Powell's job because their whole premise was to basically crush the economy. with the higher overnight bank rates, but it didn't quite do it. But right now, what you're seeing is, it's because we're issuing so much debt, and all of a sudden, the people who used to buy all of our bonds, China, Japan, a lot of these investment companies, are sellers and not buyers. Japan this week has done a number of things to prop up their currency because they've been watching. They have a target that at 150 that they come in and they support their currency. And how do they support their currency? They take a bunch of U.S. Treasuries, sell them off, and buy their own bonds.
Yep.
They're therefore helping their own currency, and that's what you've seen out of the Bank of Japan. And I also think we're seeing it out of China as well. And the main reason for that is right here. Country Garden, their largest developer. And what amazes me, you haven't really heard anything about this all week.
Well, because it's China. We got other things distracting us.
Yeah, but they defaulted on, basically caused a series of defaults on $17 billion of offshore bonds.
Ooh.
Who would be considered offshore?
Anything that's not in China?
Yeah, U.S.
U.S.
U.S. pension funds, possibly. Who invested in China, who invested in Country Garden.
And I'm sure there's a bunch.
Yep, they were supposed to make a $15 million. That doesn't seem like a lot when you've got $17 billion worth of notes. $15 million coupon, they missed it. They had a 30-day grace period, and they missed it. And that caused it's causing roughly $17 billion to go into default.
Wow. That's big. And that's, I mean, gosh, like there's so much going on right now and you see that we talk about this a lot, like the world economy now, right? Like we all hear about it, we all see it, but this is there's direct correlation. There's direct things with this world of things happening in China that are going to impact us here.
Oh yeah.
Right? And I think with this bill, the T-bill and everything, like you mentioned, like the sell-off, this and that, how do they prop up their own economy? They sell America. Like you have all that. And you look at like yesterday, we went through, yesterday we broke through a resistant level. I think the first level of support, which was, what was it? 4.875, I think. We broke through that, closed at the end of the day. And then today, resistance level 2 at 4.975, which is kind of the top. It's the top of what we have on our sheets right now. We touched it this morning and bounced down. Like, could we see us test it again today or tomorrow and break through it? That would be something that we don't necessarily want to see.
No. I mean, because when we go in and we look, Mortgage News Daily, which pretty much everyone in the industry uses and follows. I mean, we hit that number that we unfortunately thought we would hit this year, which is right there, 8% on a 30-year. And that's, again, top rate pricing, correct?
Yeah, and that's top. Like, I mean, when we say top tier pricing, that's what a lot of people don't realize is because rates are climbing so fast, a lot of lenders are doing everything they can and compressing on what they're selling and offering to clients, because if we offered, like, there's no such thing really as a rate that doesn't cost points right now. Very rarely can you ever even have that conversation. And now we're having conversations where it's to get the 8, you're paying point, right? Like that's the funny part. Like it's not, you want to get a mid to high 7s on an FHA, you're paying something for that. And we've got phenomenal price with what we see and everything else, but we're seeing that across the industry as a whole. And I think that's kind of where we are right now. And it's kind of what the feds want. Like I think we're in la la land. Like
I think it's interesting because the head of the Philadelphia Fed this week came out and he said, we're going to hold. He wants to hold. And it's amazing when you actually feel relief on a hold.
Yeah.
But you're looking at the other numbers and you're thinking, thought you wanted a soft landing. If I want a soft landing, why would I not cut a little bit? Give me a quarter point cut. Show me a little love, show me, show me you still care. Give me that quarter of a point. I mean, it's amazing when you look historically. Right here, this is a graph of the change in the effective federal fund rate over recent history.
Mm-hmm.
And you see, here 15 to 18, it was very gradual.
Yeah.
Over 36 months. 04, 06, again, gradual over about a 2-year period.
Yep.
We went from zero. I mean, this was like a rocket launch. Basically, in just over a year, 0 to 4.88.
Yeah.
But you've got analysts out there saying, "Oh, that's not going to have any effect on anything."
We don't know. Like, it's good. It's good. It doesn't impact.
Yeah, it's all good. It's wonderful. But in the meantime, you get these headlines that when Bloomberg, what it said was different than this. Reuters actually put out the truth. Bloomberg said, "Oh, Bank of America made $7 billion." Okay, but they didn't have to realize on the accounting sheet $131 billion in bond losses.
I just want to say, like, I really wish that I can be filling out stuff and be like, I'm just going to exclude this. I don't have to. I don't have to accept this.
If I sold it, yeah, I would lose, $10,000 on my car, but I haven't sold it yet. So, and I'm going to keep it for the next 27 years. So because I'm going to keep it for the next 27 years, I don't have to realize that.
Good strategy.
It's interesting accounting methods,
I like them.
Yeah.
What accounting's there for.
Oh, but
we're going to hope.
When we go in and we're looking at the February meeting right now, I kind of get it. You're looking at that jobs report, but you're looking at everything else. And everyone's saying, 93%, they're not going to raise in November right now.
I mean, I feel like we've had this, we're feeling the bumps.
Yeah.
And
we are. They always say it takes 12, 18 months for it to get into the system. And that's where we are, we really are. And that's why I keep looking like, hey, give me a quarter point cut just to, have some chance at that soft landing.
Yeah.
Just some chance, because, what are we seeing right now? Builder confidence, which had gone up in June and July, is nearing, its low for 2023 right now.
Yeah, it's headed back down.
And, the incentives they're giving is absolutely crazy. And this, we showed this a couple weeks ago, but this morning was actually blew me away, because here we go. This is Taylor Morrison on their quick move-in homes. These are homes that are ready to move in. They're finished. They're all done. They had one at $390,000. They just cut the price to $335,000.
That's a big drop.
$55,000.
So, why would they, and I'm being frank, what is that really saying? Because builders don't want to drop their prices, because dropping the price, they want to sell it, but that now becomes the most relevant comp, does it not? It
does. And that's the scary part. And this is where you start to see the price declines.
Mm-hmm.
This really, to me, is the start of not the 2007, but you could see a good 10% drop in prices overall. strictly because now you've got someone here in Solavita, okay, who just bought a brand new house for 335,000. You bought yours last year for 380,000. Some reason you've got to sell all of a sudden,
and you lost. Now you're
upside down.
I don't want that to happen to me.
Yeah.
I don't think anybody does.
No, nobody wants that to happen.
And the problem is the house you bought for 380, when an appraiser looks at this as a comp at 335, they're then going to knock off additional value off that 335 because that's new and yours isn't anymore.
Yours isn't. Yep. And then, I mean, you come down and there's, another $40,000 price cut.
About 5% right there.
5% right there. 20,000. 5% price cut. 20,000. 5%. Oof. 52,000. Roughly 15% price cut.
Yeah. So I mean, these are big cuts, and these are big changes. And the reason why they're selling them is because they can't have them sitting there, right? They're losing money. They're done. The carrying cost is now too high. Yep. And they got to get them off the books, probably because we're sitting here going, these are probably homes that I'm assuming were finished and supposed to be off the books last quarter, but carried into fourth quarter. So now they're like, now we got to really get them off the books.
Yeah. And they don't, builders do everything in quarters. And you've got to put it under contract, by mid-November, so that it closes and it's off their books on December 31st.
Yeah.
When they close out their quarter. So they're getting aggressive. And at the same time, they're offering this price. They're offering their buy down still and their closing costs still. So I haven't looked at the profit, the earnings yet on the builders, but I think come December or January when the new ones come out,
I think
fourth quarter is going to be.
It's going to be very ugly for a lot of builders.
Yep, it really is. So, but this is where we got to start keeping an eye on it, because this is what can start to bring down the whole market. Is once the builders start having to do these kind of discounts, and now you've got the resales within those subdivisions. So that's something we really got.
You know how we fix this?
You cut rates.
Oh my gosh! Right, and we don't even need rates back. I will say, I think it's going to be. I think this is where my mind's at now, and you can tell me if you think I'm wrong, Brendan. I think that this whole smooth landing that was the talk of the town forever with the feds, right? With Powell, which mysteriously left his language and vocabulary no longer being spoken about the last 2 times I've heard him talk, right? I think they're realizing this isn't going to be smooth. This is going to be bumpy. This is going to be like, oxygen masks flying down on the airplane as they're coming down for a rough landing, right? We're going to feel it. But just like an airplane that has a rough landing, it's going to suck for a little bit, for a very short period of time. And then you're going to be like, oh, we're back on the ground. We're okay.
Yeah.
I think this time next year, I feel like they're going to knee-jerk reaction. I feel like we're going to see a bigger shift, and we're going to see, I mean, I've seen a lot of experts say fourth quarter next year back in the low 6s. I think it's possible now.
I think you're right. I think, and it's unfortunate because these are, this quote, the smartest people in the room. But sometimes, here's an easy way to put it. Who are the people who run all the companies? They were the C students, right? Because they learn street smarts. They get their hands on things. And the people on the street are saying, hey, we need to do this right now. We don't need to go down to 4% again. No. You don't. Yeah. But that 6.5 mark is still in my head. At 6.5, we were still a very steady market. And if we can get back down to the 6.5, because I'm with you. What I see is, we're going to hit some real recession numbers first part of the year, January, February, March. They're going to knee jerk. Instead of doing a quarter point cut now, maybe a quarter point cut in January, they're going to come back and do, all of a sudden July hits and like, oh, we're going to cut it 0.5%, or we're going to cut it, 0.75 of a point. And it's like, well, why didn't you do it back there? You've done this long enough. You're supposed to be the smartest person. Come on, guys. Use your heads. Like my mom used to say, use your head, Brendan.
Well, what is it, the adage that you always say, or a quote you always say, a recession is when your neighbor loses their job, a depression is when you lose your job.
Yep.
Right?
Yep.
All these people making the economic, none of them are really impacted.
No.
Right? They're not feeling it.
They're government workers. I mean, has Yellen ever held a private job? I mean, she started in the 70s in the Treasury Department. I kind of feel like it's like the first President Bush, who went into the grocery store and they had the scanners, and he was like, "Oh my gosh,
what's this?
That's so cool."
And you're like, "Wait, no." Actually, I don't remember that. I'm going to be honest.
We've had them for a couple of years now.
Yeah, and that's the thing. Like, they don't, and you have, and you see a lot of this stuff in the data going out there, and like, I get it. Like, I get the frustration. I get it. But it is, the one thing that is interesting is people still need to buy and sell. People still need to move. People still need what? You have to have a place to lay your head down at night, right?
Yeah.
Real estate still turns. The market, there's still opportunities. The great part is what? We got inventory now.
Yeah. I think for buyers, we're flipped. We are flipped to a buyer's market.
100%.
Yeah, I'm not afraid.
I'm a buyer. I'm negotiating, aggressive. I'm getting a temporary rate buy down, a 2-1 or something of that sort to make sure my payments are going to be comfortable until we see those numbers come down permanently and I can refinance in good shape. Like, I mean, I might be negotiating. I'm offering a little bit less than asking price and asking for concessions.
Yeah, I mean,
that's me. I'm not saying don't take my advice. Like, not every property you can do that on. Got to talk to your realtor and figure out what makes sense.
But I got a client in the 250 range that at 250, they were gone in like an hour.
Yeah.
And those are sitting on the market right now.
Yeah.
For a week, 2 weeks, 3 weeks.
Well, I think the key here is with rates where they are, and those, when you show Mortgage News Daily and it says rates are around 8% right now, that's primary A paper top shelf deal, right? When we go investor, they're even worse.
Oh man!
Right? So I think in that 250, which investors have been gobbling up, well, now it's the carry cost with the higher rates. You got to be a cash buyer on the investor side for it to make sense.
Yep.
So I think that gives more options for those first-time buyers that are in that price point, because you're going to have a little bit less competition, because you won't have the investors that are financing homes in this market.
Exactly. But I do want to bring a good piece of news to everyone. And this, I think, is wonderful because you've been working on this extremely hard. And that's being able to not calculate property taxes in the purchase for a 100% disabled veteran. Go through that and explain what's going on in the state of Florida right now.
So this is actually really cool. So I've been working with a lot of people don't know this, but I'm a state captain here for the Association of Independent Mortgage Experts. So for AIM, which is the largest mortgage, group or whatnot for mortgage brokers and so forth. But one of the big initiatives that we've taken on in Florida this year was really to focus on something we've seen other states start to implement, but we haven't seen happen in Florida. And that's where you have a 100% disabled veteran, right? In the state of Florida, and in most states, almost every state, I think, they're exempt from property taxes if they're 100% disabled. But the process has always been that you have to qualify on the tax bill, close on the home, and then afterwards, you can apply for that exemption. So you got to pay extra money. You got to do this. You're reduced. You're factored into debt to income ratio, all of this. Well, we've been pushing to get this changed. And it simply is getting an exception letter or a preliminary letter from the property appraisers when they have an executed contract and so forth. Well, there's officially been a Senate bill issued, Senate Bill 172, in the state of Florida for the 2024 session, which is actually proposing exactly this. So it's been a huge point of emphasis. I know that the Florida Association of Property Appraisers is behind this. The DFW is behind this. There's so many strong organizations. AIM obviously is behind this. And we're really focused on getting this passed. We'll have more information about this and how you can. But if you talk to a representative in your area, like bring this up if you're a veteran, bring this up if you're not a veteran, because this helps. When we're talking about higher interest rates or higher this, right now, that difference for a veteran who doesn't have to, it doesn't cost the state any money, because right now, if a veteran does this, they refund back to the veteran anything that's paid if they are 100% disabled. Right. Okay. So it's not like it's actually a process in which the state loses money. They don't. This is just making it to where it never has to be factored and done up front. So it doesn't have to be fixed on the backside. Yeah. Right.
So it allows them to actually qualify for more
now home. They can qualify for more home, depending on the county and location. It could be $50,000 to $70,000 in buying power. Right. Like that's huge. And I think it's just the right thing. It makes sense. Our veterans served us. They help protect us. They're there. Like, this is something that they've earned. Like, why not make the process a little bit easier for them?
Oh, I agree with you wholeheartedly. On that one. So that's something I think is very important. And we need to reach out to all of our associates and make sure that they're letting the representatives know, hey, this is one you can back, no matter what side of the aisle you're sitting on.
Exactly. How can you be against that, right? And if you want more information, if you're watching this video or anything, shoot me a direct message, send me something. I'll follow up with some email some information for you. Brendan will have it as well. This way you guys can know how to support. We're going to make it super easy on some of this stuff to where you can click and send letters to your representatives. And the thing is the more we follow up on these things, the more likely the more attention's drawn to it, the more likely it's going to be taken seriously. This thing is going to get passed, but it only gets passed if we show that it is an important item.
Yep. Very true. All right. Well, let's hop in.
Numbers.
Woo, woo, woo. And they're boring. We're just holding steady. Average, this past week, 346 homes sold. Not much difference from the previous week, at 351. Inventory, we broke the 5,000 home mark.
Ooh.
Which I think is very big, because that number, before back in December, I believe we hit that number as well, and that really did help push everything to a buyer's market like early January.
Mm-hmm.
Our condos are taking a beating. Oh, wait till you see the graph. Only 104 condos sold last week, and our inventory increased 53. So we've got over 2,000 condos sitting on the market right now. And this number continues to actually decrease, which isn't good for sellers, which is our original list to sales price percentage has dropped to 93.4% over the entire market. And that over 1 million, there we go. I look back the past 2 weeks, and we are sitting right there. We're 84, 86. Now we're roughly 80, 88. The high-end stuff is just sitting. I actually was looking for a client we're going to be showing on Sunday. And a couple of these homes have been on the market for nearly a year.
Wow.
Now. I was like, whoa, I didn't realize that. I've seen some 70, 80 days, but one of the ones we're looking at, I believe it's actually 454 days. It's a lakefront in Windermere on the market.
It needs upgrades. It's Windermere. It's probably
it's
built
nice.
in the 90s.
It's gorgeous.
Oh, never mind. All right. Yeah.
But you see, when you look at our graphs, this number has dropped. The period average has dropped about 20 units in the past 2 weeks.
And I think we're going to continue, because remember, we're in mid-October, which means that we're talking, I'm looking at my numbers back here. So contracts that were executed mid-September, and I'm scrolling back. Let's see, Friday, September 15th, 30-year MBS was at 5.5 coupon, was 98.04, right? We're on the 6% coupon now, and this morning we're at 96.66.
Ouch.
So that's like we're on a worse coupon, and we're going to see, I think, as we get into early November, I think we'll see sales numbers drop considerably.
That's
I didn't say, I'm sorry. I'm walking out.
Yeah, thanks. You try to give some good news and you just bring me down, man.
Stop watching before we go into these numbers. No, I'm just kidding. Always watch these numbers. There we go.
But then again, I'm going back to, as a buyer, these next 3 months, if I can structure it right, I can still make it work for a good deal.
You talk about that $1 million, the high-end luxury. I might be asking for a 3-2-1 in the luxury market.
Oh yeah. Oh my gosh. Oh, you could probably get it.
I mean, I've only seen, our company has closed 1 3-2-1, and it was on a just under $1 million property, and it was expensive. But that was, I mean, you're talking 3% last year, 2% last year, 1% less. And here's the thing, like the 2-1s, and I think this is where we talk, and this is my fault, right? And I'm getting off track. But we talk mortgage jargon all the time. We talk 2%, 1%. What's the primary purchase price point right now? It's at $300,000 to $400,000, right? That's where the bulk of sales.
Yep.
A $400,000 loan, right, is roughly that 2-1, that first year that's 2% lower, is roughly $530, $540 less a month. That's a car payment.
Yes, it is.
That they're not paying. That's a big savings. And then year 2, it's like $260. That's your electric bill. Like, these are significant savings. And I think sometimes we get stuck in the mortgage industry and real estate as we talk in this rate because we're super familiar. But the reality is that's a big savings.
Yeah. Yeah. And like you said, I believe last week, it's that payment. We got to start talking about, okay, plan out for your payments, you know, and what the market's going to do, because you drop it $500 a month, all of a sudden, hey, but have a plan to get out of it. Yep. Because look at that refinance down the road and stuff. So it's a plan. It's not just a simple, hey, I'm buying it. It's a plan. Let's see. Let's look at our chart for inventory. And you see right here, we are up 8.53% from January 2023. And we broke the 5,000 barrier in homes, which actually nice to see because we needed it.
Yeah, we need inventory. It.
Yep. And then I'm watching this now, the temporary, off market, and the withdrawn.
Okay.
And we're seeing pretty consistent, on a weekly basis, about 50, 60 people are actually taking their properties off the market, either temporarily or, here people were averaging about 100 withdrawals a week. And, that's again where, seller expectations and current reality have just not meshed well.
Yeah.
So, it's one of those things. It's a difficult conversation we've got to have these days with people in that, hey, with the rates going up, we're going to have to tighten, instead of making, $250,000 on your house, you may only be able to make 240. It's like, oh, that's horrible. But it's important because, like, we had a client you and I were working on earlier this week where he would have walked with roughly about 225,000, but he had a mortgage that he wanted to stay within. And looking at the newer homes that he was looking at, he unfortunately it was going to be a little bit higher. And it's one of those where it for him financially didn't make sense for him. So he's like, you know what, I'm going to hold a little bit. I'm like, okay, I understand completely, because it is a tough decision. You know, even though you're walking with all this equity, you know, when you look at the new payment, it's got to mesh together.
Yeah.
You know, so and then we look at our condos, and condos, you know, sitting about 96%. This has really gone up. We're up to 50 days on market.
Okay. Yeah, taking a little bit longer.
Yep. And then here's our graph for weekly sales. Ew. Boom.
Boom. Yeah, it's just dropping.
Yeah, that was a bump. That was a bump. So overall, I mean, the market, you know, Orlando's holding steady. I don't particularly like to see the cuts that Taylor Morrison is making right now. But I think, quite honestly, we're this far. If we can get a little relief from the Fed or from the Treasury, you know, like stop borrowing so much money.
Yeah. We can
if
see
get that little bit of relief. What's that?
We can see ourselves stabilize.
Yeah. I can see it coming back very easily. It's just, I think for the next couple months while we're going through, Yellen finishes, you know, issuing all this debt. I mean, it's amazing that right now we are paying more on our national debt than we are for our defense. And you know what the defense budget is?
It's a big one.
Roughly $800 billion. So someone needs to pull the reins in and say, no. We got to cut this. You know, this has got to stop. Period. Yep. Absolutely. Period. So, all right. Well, that's our show for this week. Thank you everyone for joining us. Please like and subscribe, and we will see you again next Thursday. Take care.
Guys.